All right, my friends, welcome back to Real Estate Bites. This is episode number 63. We come at you every Friday at the lunch hour, bringing you some good real estate information that you can chew on over the weekend. As always, I ask that if you like the content you see, if you feel it is valuable, and you have people in your life who might be able to use some of this information to their benefit or simply to satisfy their own interests and curiosities, please share this. Please share this with friends and family. Let them know we're bringing good information to you here every week. All right. So today I'm bringing on a friend of show and a very frequent contributor to Real Estate Bites, my friend and partner, Jay Slone. Before we get into the meat and potatoes of what I want to talk to Jay about, we always like to start with, oh, that's the wrong button. We always like to start with a little bit of humor. So I'm going to share this meme of the week. You don't believe in climate change? Your insurance company does. Hey, no doubt about it. Most people I know have, they've seen their home insurance rates go up 30 to 40% this year. And that's in response to, things that had happened in past years in Florida, tornadoes that come ripping through the Midwest. Now that we're seeing, the damage done by Helene and Milton, what's going to happen to our insurance in 2025, folks? I don't know. I'm going to tell you what, though. I am going to plug my boy, Tony Larizza. You can see his name and number on the screen. This is my insurance agent, someone whom I trust very much. Let me tell you about Tony. Tony, whenever it comes time for renewal, without even thinking about it, I never have to think about it because Tony, at renewal time, shops my rates, comes back to me with what he finds in a consultation. Hey, I found potentially better rates here, maybe better rates there, or maybe, here's what the other rates look like with the other companies who I work with. It might be best to stick with you. So if you want an agent who's proactive and communicative and is looking out for your best interest, record that information that's at the bottom of the screen there and give Tony a call. He's one of the best that I've ever worked with. So that's Tony's info. Give him a ring. He's been on the program before, talked about roof damage and how it's impacting new home buyers and stuff like that. He's great. All right. So my next guest here is Jay Slone. You've seen him on here before. He is a business partner of mine. We do a lot of business together, someone whom I trust as much as anybody in this industry. Before I bring the man on, though, I want to share a little bit of a promo that Jay's done. Take a look at my man.
At first, I actually used OFA. So I actually got my first loan in this building that I'm sitting in right now. I work downstairs. I was actually just a little low-level loan officer, actually right around the corner from this office. And I did an OFA, first-time homebuyer program. John Schrankel was my loan officer. And I ended up bringing, I think, $400 to close. So I bought my first house with literally $400 out of my pocket. If you are interested in home ownership or learning more about it, please reach out to me. I'd be happy to walk you through all the incentives. There are so many products out there now for first-time home buyers, grant programs, very little money down, and just different opportunities for you to buy, not just as a first-time buyer, but also as an investor. We have pretty much every program available. So please reach out to me for more information.
Without further ado, Jay, welcome back, man. That was a nice little video, dude. The production's fantastic, man. Look at you.
Hey, thank you. I appreciate it. And I can't even take credit for that, man. I hired a great media, social media guy, and he's fantastic. So,
well,
Alex, you joined us. Yeah, you joined us for that meeting, right? Yeah, he's awesome. So I talk a lot, and he edits it and makes me look good. So.
Well, so listen, Jay, you started this venture 7 months ago. You opened up Legacy Home Finance.
Yes.
You're growing. Tell everybody how you're doing, man.
I've been really blessed to have great partners like you and several others that have continued to support our business. We always believe in doing the right thing for our clients and representing you well. We think our firm belief is we're a direct extension of you and your brand. So we want to represent you to the best of our abilities, obviously. And it's been great. So we have 2 loan officers that have started within the last 3 weeks. I have another 2 actually on deck right now. One which I'm really excited about, is going to actually head a Spanish speaking initiative that I'm starting here at Legacy Home Finance, which is great to serve our Spanish speaking community. So I'm not going to let him work with you on all the deals, just the Spanish speaking ones, Jonathan. So trust me, I know you
Muy
can.
bien, muchísimas gracias.
Whatever. I can't speak. So he's going to head that up. He's going to be a member of NAREP. He's going to work in the Spanish community. I think it's highly underserved in Northeast Ohio specifically. So I think that that's going to be great. And then, I have a great interview set up next week with another very high producing individual. So really excited, all great people. So I'm not really, just as a plug for my business, if you have finance background, sales background, that's great. I'm looking for great people to build the foundation of our company around, that do the right things, that really look out for people and have good character. And then the rest will take care of itself. We'll train you and make sure that you are successful here. So
there you have it, folks. If you're a great human being who is dedicated to serving people, Jay's looking for you.
Absolutely.
Right on. 7 months ago, you started in a home office, and now you got this beautiful place that I've seen. 2 LOs on right now, a third one coming on, who's going to allow you to expand business to a demographic that is underserved, and this is amazing, man. I'm proud of you, my friend. I'm proud of you.
Thank you, brother.
So look, wanted to talk to you today about interest rates, right? It's always a topic of conversation. When people talk about real estate, it's only a matter of time before they begin to talk about interest rates and what they think is going to happen. Should they go up or down? We started the year right around where we're at right now. And then in April, we climbed up to about 7.5. And so this morning, when I checked on Mortgage News Daily, the interest rate for a 30-year conventional note was 6.68%, right? So we were just a few basis points higher than that at the beginning of the year. And then, like I said, in April, it had climbed up to 7.5. And then, in August, the Fed announces rate cuts. We see the rates plummet down to 6.15, I think is right around the lowest it got. And, within the last 4 weeks, it's bounced back up a whole half point up to where we are today. So explain to me and explain to the viewers why we're seeing this kind of roller coaster ride with rates.
Yeah, that's a great question. So a few things, we're still in the sixes, which is good news to your point. So it's still a great time to buy as in comparison to where we even were last year or, 6 months ago. Okay. So it's still a fantastic time to buy. Second thing is that, 10 years, if you look at the 10-year treasury, really, that's kind of the cheat sheet for everybody. If you're interested to know where rates are, if you look at the 10-year treasury yield and you add 2.5% to that, you're pretty much going to get the par, what's called the par or no cost to you interest rate for a 30-year fixed. So right now, the 10 years trading at 4.07 at this moment. Okay. You add 2.5% to that. What does that put you at? Very close to what you just quoted, right? So it's all, right in that range. Now, the reason that rates started trading well, and they traded really aggressively and rates were at their lowest a week even prior to the Fed cut, which is where I was locking a lot of my clients in, is because the market is speculative. So the market is about what is going to happen, not what is even really currently happening. What is currently happening is already outdated, right? You agree because you're an investor, right? So you know that. So a lot of the rate cut was already baked into the rates that we were seeing already because they had, the market had determined
before the actual
cut, there was at least going to be a quarter to 50 basis point cut. So the market already positively reacted to that. Now, why did the rates automatically bounce back? Well, inflation is still an issue, and inflation is the number one reason, not the Fed, that 30-year fixed mortgages were in the toilet for a little bit. Okay. So with inflation still being a problem, even after the Fed cut, the market's reacting to it. So why is inflation becoming a problem? Well, we have two candidates that are out there specifically right now. It doesn't matter if you're a Republican or Democrat. Both of these candidates are really talking about spending a lot of taxpayer money right now on both of the things that they're wanting to do. So their economic policies are already having, with the election, 40-ish days away. we're 30 days away. We're within 30 days away. Their economic plans are already starting to have an impact on the market. And to be candid, every time a president is elected, rates go up for just a little bit because nobody knows and the market doesn't know. I can't forecast, getting back to that speculative thing. They can't put a finger on exactly what their economic policy is going to be because they haven't created their cabinet yet. There's a lot of unknowns, right? So things start to just trend upward because there's risk, and the market reacts negatively to it. So there's still a lot of housing inflation. Shelter costs are still extremely high. The consumer pricing index is still extremely high, meaning that everyday people like you and me are still paying more by a few percent than we were prior to that or leading up to that Fed cut. I mean, they're almost up, I think, half a basis point of where we were or where the inflation was when they felt comfortable in cutting. We're already past where they felt comfortable in cutting a little bit today by some of the reporting that's come back. So unless we can get inflation back down a little bit, I'm really kind of concerned that there might not, be another Fed cut in December, which all economists were calling for, and then another Fed cut to start our new year, in the first quarter of next year. So they were thinking we're going to get a 25 to 50% basis cut, then another quarter to 50, and then another quarter to 50, to where the Fed funds rate would be somewhere in the neighborhood of 1% to 1.5% better than we were, this time last year, in the next 6 months. And I don't know if those things are going to happen now.
I think it's an important point for people out there watching to understand that when you're looking at rates today, that is not a reaction to something that's happened. It's not a reaction to what banks and Wall Street is looking at today.
Mm-hmm.
These are projections, right? So when you're looking at today's rate, what you're looking at is a forward-looking approach that is done by the largest banks and lenders, right? So the banksters who are, they're the ones with so much money and so much control over the economy. They're looking into the future. And to your point, Jay, they're concerned about inflation, and they have raised these rates back up because they believe the loans they write today, in the foreseeable future, they need that interest rate to basically stay above water and make the kind of money that they need to make to stay in business and earn the profits that they project, right? Specifically for their investors.
Mm-hmm.
So that's what you're looking at. So as long as rates stay high, then that is the banks announcing to the public that, hey, we think in the foreseeable future that we need these rates to stay high because inflation is going to be so problematic that we need higher rates to make the money that we need to make.
Yep. And it's a big problem too, because let's say, the banks in the larger banks, they hedge and they make the wrong bets. And they buy or they place a whole bunch of loans and then rates go up drastically and they're not priced. Their secondary market or their portfolio of loans that they just locked are worth less, or they're negative. So the bank can lose, and the institution that's placing and locking these rates, they have to price accordingly or else they are out a lot of money, and that could lead to a lot of problems for them. So just hang in there though. And let me explain I want everybody to understand. Yes, the market is up, but it's still down. It's up from where it was 3 weeks ago, but it's still down year over year, and still locking in. And, me being a broker, Legacy Home Finance, we shop around for the best deal for you. We can absolutely still, I just locked in 2 clients and still in the low 6s. Yes, did they pay a little bit for it? Yes, but not very much. And, we help them out. So it's still a great time to do something while a lot of people are still on the fence. Just to give a prime example, a few clients that I had that right during those 2 weeks of where we were seeing some really aggressive rate drop, their competition out there for the homes they were making offers on was already up. They were already in multiples, more multiples than we're used to. Everybody's in multiples right now, don't get me wrong, but they were in negotiations against, 8 to 10 offers, whereas maybe we were against 4 before, right? Or 5. So the best time to buy is always still right now, because as these things continue to happen, where there's still more demand than supply, and there's better rates involved, it's going to push those price points up again. So that's why I disagreed. And I made a post, and then I'll get off my soapbox here, but I made a post about, a certain party's idea to just give every first-time home buyer $25,000. That's a bad idea. And I'm not getting political here because the other side doesn't have really a handle on what's going on with housing either. But the point is that if you gave every first-time home buyer $25,000 additional cash, it's just going to flood the market with inventory. We don't have to back it up, and it's going to make everything much more expensive. So then that $25,000 isn't going to matter because now you're paying $70,000 inside the next 2 years for that same house. Okay. So that $25 grand, yes, it was great to have down to help you, but you're going to pay more because you're going to have so many people involved bidding on that same house. It's going to drive that pricing up.
It's creating artificial demand.
Exactly right. And that always creates pricing issues. And that's what we've seen. I think again, and I think we talked about this on one of the other podcasts, but, we got to get building costs and housing costs down by the way of, maybe giving breaks to builders. The building costs for homes are absolutely up. And the reason that the market is still flooded is because rent is now at all-time highs, not just in Ohio, but across the country, because a lot of these larger hedge fund corporations don't have any type of sanctions on them whatsoever. And look, I believe in capitalism, but we have hedge funds buying 20 to 50,000 single family homes a year. That's crazy. So if you have a single mom or your client out there competing against, BlackRock, Blackstone, and some of these open doors and all these private equity companies, how is that really fair to the American consumer, right? So there's a lot wrong that needs to be broken and fixed. Neither of them, seem to have answers or hold on what's actually happening.
And Jay, when you just mentioned in that, talking about these hedge funds buying up these properties, 40 to 50,000 a year, when we had those all-time low interest rates, it was closer to $1 million a year.
Yeah.
Right. So
I'm talking about per firm. I'm talking about they're buying maybe hundreds of thousands. I might even be lowballing it, but I'm just saying, just to give an example,
sure,
they're buying homes and then renting them back to America.
Sure.
For 2 to 3 times more the rent than a regular investor like you would, right? You would be fair in your market rent where they're just going, okay, we could get 600, we're going to get 1,000,
You hear people all the time say they want to wait for lower interest rates, wait for lower interest rates. I watched this pundit today on MSNBC talk about if we could just get to 6 or right below 6 would be perfect. I don't know. Getting to 6% certainly doesn't fix the inventory issue that we have, which really is, in my opinion, it's the bigger factor of everything. I mean, we have had this all-time low inventory now for a few years.
Mm-hmm.
In that time, we've seen rates drop or go up significantly, and it has impacted demand. There's no doubt about it. However, with the decrease in demand, there has not been a correlating decrease in prices. They're still rising. I mean, it may change over the next quarter or two, but I'm tracking median square foot values here in Lorain County, and it's a decent sample size for what's going on in this region of the country.
100%.
And prices are still going up. So folks, all-time low, going back to super low interest rates is not going to be necessarily the answer, and it's not going to be healthy for the housing market. It is, if we see low interest rates again, prices are going to go up. Hey man, I want to wrap this part of the conversation there. And before I let you go, I want to ask one more question.
Sure.
We talked about it again. You started this thing 7 months ago.
Yeah.
I'm sure there's been a couple bumps, couple bruises, smack across the mouth here and there. What's one thing that you've learned in this past 7 months that, I am an advocate for entrepreneurs or the entrepreneurial mindset. I love seeing what you've done, and I love seeing people take that risk because if you really want to grow something incredible in your life, you've got to take a risk like you have, Jay. And so for people out there who are considering this, whether it's in real estate or any other industry, if they're thinking about breaking off on their own and doing their thing, what sort of advice would you lay on somebody who's struggling with that in their mind and can't quite pull the trigger?
self-doubt, get over yourself. I think the biggest reason people don't execute, and this is me included, I'm not, the reason it took me so long to start my company is because I just was scared to pull the trigger. I was scared to bet on myself and not, just double down on me, man. I mean, invest in me instead of investing my career and putting myself into other people's hands when I knew I was more than capable. And I think that a lot of people, we doubt ourselves and don't think we can do it when we know we can in our heart of hearts. We're just scared to take that leap of faith because of you number one, you're scared to do it. But also I think the perception of what other people think and the scared to fail overtakes your belief system in yourself. So my biggest piece of advice would be to you have to get over that, and you have to get over and stop caring what people think.
How did you do it?
I read something that changed the way I thought about it forever. So I read this quote that said, never worry about how you feel about anyone's advice, or I'm sorry, about anybody's opinion if you would never ask for their advice. So meaning that, why would I care about what you say about me at all if I would never ask your advice? And I can really count on my, I have some great mentors and things like that. So I have some great people, including you, that I would rely on to ask serious questions or worry about, my perception with those people. Outside of that, I let it all go. So that's why I do videos now. That's why I put myself out there more. That's why I invested more, because if I fail, I'm okay with it. And also I didn't want to live with regret. So I didn't want to say, you know what, I never did that. I know I could have done it, but I know I don't ever want to be a could have been guy. Especially when you're raising young men, I never want them to look at my dad and say, yeah, he could have did that. Or we could, you know what I mean? Mm-hmm. I never wanted to be that. So I had to overcome it for myself because I was really kind of, scared to do it. But then I knew that I could, and I'd also been let down. So I've gotten punched in the mouth along the way, and I just got kind of fed up with that and said, you know what, if anybody's going to let me down, it's going to be me. But that hasn't happened. I fall to the level of my own expectations, or actually I never rise to the level of my own expectations because I keep raising the bar for myself to strive for more. So, and I think people will be really surprised that once they let that go of their ego and what they care about what other people think, how much they can actually do. So my best, it sounds corny and cheesy, but you got to double down on yourself. Put your time and energy in things that are going to give you the return, and just put one foot in front of the other and get it done and execute and have a plan. Make a plan. It took me 6 months before I opened the doors for Legacy Home Finance to actually build it before I even opened the doors. So I had a blueprint of exactly what I wanted to do. I had small and big goals that I wanted to hit and milestones, and I just focused on that. But my number one thing, getting back to your question, was I stopped caring what other people thought, and I just went for it, man.
It's beautiful, and you're killing it. You're doing great, man. I've been to your office. It's beautiful out there on Oak Point Road, and God bless you, my friend. Keep doing your thing. Keep growing.
Thanks for having me on.
Absolutely, man. I thank you, Jay, and we'll do it again sometime in the future.
All right, sounds good.
All right, my friend.
Take care, everybody. See ya.
All right, that was Jay Slone of Legacy Home Finance again, and we're going to wrap up this week as we jump back into statistics and all this other fun way that we wrap up every single week here. So let's take a look at the past week's statistics in real estate sales in Lorain County. Again, I only look at Lorain County. It's where the vast majority of my business is. But, I'm always looking at the market through the greater Cleveland area. And usually what I see, of course, county to county, there's differences because you got, obviously Cuyahoga is a larger metropolitan area. Summit County, you got Akron down there, larger metropolitan area. So there are some changes, but I have found, looking at other research, that this sample size of information I get from Lorain County, not only does it apply to Northeast Ohio, but really the entire state and the entire region. The trends that I'm seeing here are applicable throughout the Midwest for sure. So here we are, episode number 63. This morning, when I took a look at the MLS, there was 449 single-family homes and condos active on the market. Again, that number does not include multifamily, nor does it include mobile manufactured homes. Last week, there were 63 closings in Lorain County. The median square foot for those closings was 1,476 square foot. Median home value was $245,000. The median square foot value, we just talked about this a bit, $166.88. The average for Q3 2024, as you see over here, was $160.82. So we start off Q4 right around or above where we averaged, and this average was higher than that in the past. So we can see in real time, home prices are still appreciating. Median days on market for sales last week was 18. We talked a lot about interest rate right now. And then, as always, we talk about the big sale of the week. Over the past week, it was $715,217 in the Ridgeway. It was on the south end of North Ridgeville. I forget the name of the development slipping me right now. But at any rate, that's it for this week. I appreciate you guys showing up again and joining me here for Real Estate Bites. Listen, as always, take care of yourselves. Take care of one another. I love you, people. We'll see you next week.